Welcome to the Deep Dive. Today we are taking a close look at the Amer Sports Q3 2025 earnings call. This is the company, ticker AS, that owns these powerhouse premium brands like Arcteryx, Salomon, and Wilson.
And this release was a big one. The timing really amplified it. Amer Sports dropped these results before the market opened on Tuesday, and the reaction was immediate, just overwhelming buying pressure.
Right. The stock surged, 8 or 9% on the day?
On heavy volume, it basically told Wall Street everything they needed to know. This was a classic, significant beat and raise.
So that's our mission today. We're going to go beyond those headlines, dissect the numbers that powered this thing, and really understand what's accelerating inside these brands. Because the updated guidance seems to have, it's really altered the whole story around Amer Sports.
It really has. Let's start with that snapshot that hit everyone's desks. This wasn't just a small beat. It was a comprehensive beat right across the board.
Okay, so give us the top line numbers. What got the market so excited right out of the gate?
All right. Q3 revenue came in at $1.76 billion. That's a nearly 30% increase year over year, 29.7% to be exact. So, a solid beat on the top line.
A solid beat, but the stock reaction felt like more than just solid.
Exactly. Because the real story, the real surprise was on the bottom line. It was about profitability.
Okay, let's look at the EPS.
So you always have two numbers. The GAAP earnings per share, that was in line at 25 cents. But the number everyone looks at, the non-GAAP adjusted EPS, which shows the core operating performance, that came in at 33 cents.
33 cents. The consensus was 25. That's a huge, 32% surprise. When you see a profitability beat that much bigger than the revenue beat, it tells you something's going on with the margins.
It speaks volumes about the quality of the sales. The flow-through was just phenomenal. Adjusted net income more than doubled. And that's what gave management the confidence to come out and say, look, we're exiting Q3 with real structural momentum heading into the holidays and, frankly, into 2026.
So let's drill down into that. Where did this growth actually come from? Which of the brands really delivered?
Well, it was led by the two big high-margin segments. Yeah. Outdoor performance, which is really Salomon's territory, was the fastest grower. It surged 36%.
36, wow.
And technical apparel, which is mostly Arcteryx, wasn't far behind. It accelerated to 31% growth. Even Wilson, the ball and racket segment, which is more mature, even that accelerated to 16%.
For the longest time, the whole Amer Sports story was really just an Arcteryx story. This sounds different. It sounds like Salomon is really stepping up.
It is. And management is now explicitly calling Salomon the second leg of profitable growth. That's a huge strategic shift. Mm-hmm. They're pushing hard into Salomon footwear, apparel, bags. These are higher margin categories, and it's lifting the entire profile of the company. We're watching it become a true co-anchor with Arcteryx.
So if they're shifting the product mix like that, that brings us right back to margins. Is it just selling more stuff, or are the economics getting better?
It is absolutely about the economics getting better. And this, for me, was the most impressive number in the whole report. Adjusted gross margin expanded by 240 basis points year over year. It hit 57.9%.
Okay, let's pause on that. 240 basis points is a massive jump. What exactly is driving that kind of improvement?
It's a trifecta, really. First, channel mix. They're selling more through their own stores, their own websites, DTC. Right. Second is product mix, just like you said. More high-margin apparel and footwear. And third is geographic mix. They have incredible pricing power in Asia, particularly in Greater China. That margin number is direct proof of brand equity.
And that strength carried all the way down the income statement.
It did. Adjusted operating margin also expanded, up 130 basis points to 15.7%. And what's crucial here is that this happened while they were spending more. They're pouring money back into marketing and store build-outs, but the core engine is so profitable, it's still driving margin expansion.
Okay, let's talk about where these sales are happening. You mentioned channel mix and geography. Let's unpack that.
Right. The whole structural growth story is really about two things: direct-to-consumer, or DTC, and Asia. DTC revenues surged 51% year over year.
51%.
That's a huge number. Yeah. And that just blows away their wholesale gross, which was, a solid 18%. But 51% is a different league. It shows they control their own destiny.
And what about regionally? We've heard the U.S. market has been a bit choppy for some apparel brands. Where's the strength?
Well, all regions saw double-digit growth, but Asia-Pacific, APAC was the leader. It surged 54%. Greater China was right behind it at 47%. Even the Americas accelerated to 18%, which is quite strong. That demand for premium technical gear in Asia is just incredibly resilient.
Can you give us a concrete example of that DTC channel working?
Yeah, look at Arcteryx. Their Omnicop growth, so that's online and existing stores combined, it accelerated to 27%. That was up from just 15% in Q2. Management said it's all about traffic and just massive brand awareness, especially with younger consumers. The brand is a status symbol.
And they're building out the physical stores to support that demand.
Absolutely. Salomon is expanding like crazy in Greater China. They're on track for something like 290 shops there by year end. But it's not just Asia. They talked about the new LA store on Melrose, calling it a huge success. It's attracting a lot of new, younger female customers, which is a key demographic for them.
Let's pivot to the bigger strategic picture here. The management commentary really hammered home this idea of moving away from seasonality.
Yes. And for long-term investors, this might be the most important part of the call. The outdoor segment used to be all about winter sports. Skis, snowboards, things that depend on the weather. Management now says winter equipment will only be about 28% of that segment's revenue for this full year.
28%. Wow. What was it just a few years ago?
It was 46% in 2022. So that's a dramatic shift away from weather risk.
And that mattered to investors because it makes the earnings more predictable, right?
Exactly. You get rid of that volatility from a warm winter.
Yeah.
You become a more reliable year-round compounder, and the market will always pay a higher multiple for that kind of consistency.
Okay, let's get into some brand specifics. Arcteryx is still the engine. What exactly fueled that 31% acceleration?
It's pretty broad-based, but they highlighted two areas that show you the future runway. Women's categories grew 40% in the quarter, and footwear grew 35%. They are strategically pushing into both of those hard.
Interesting. And what about the flip side? What about Salomon in North America? I know there's been some noise there.
Right. This is the main near-term risk people are watching.
Right.
While Salomon is on fire in Asia and Europe, in North America, they're doing what they call a strategic pruning. They're pulling out of lower-end wholesale channels that they feel dilute the brand. It hurts sales in the short term, but they see it as non-negotiable for the long-term health of the brand.
So they're choosing brand equity over near-term volume, and they have a timeline for when that cleanup period ends.
Precisely. Management was very clear on this. They expect the distribution to stabilize and for the benefits to really start showing by the first half of 2026. That date is now a huge pivot point for investors.
And really quickly, what about Wilson? How's their new retail strategy going?
They're making good progress. The Tennis 360 concept store is working, especially for soft goods like apparel, which more than doubled. They're focusing those stores in Greater China and what they call the U.S. Smile States, places like Dallas, Miami, Beverly Hills.
Okay, before we get to guidance, we have to talk about risks. There were two big ones, tariffs and that high-profile fireworks incident with Arcteryx in China.
Yes, and management addressed both pretty confidently. On tariffs, they said they expect a negligible impact. They just have too much pricing power to be worried. And on the fireworks incident, they admitted the start of Q4 in China was a bit softer right after it happened. But they were quick to add that sales have already rebounded strongly, which suggests that brand equity is still very much intact.
So after this huge Q3, and with those risks seemingly contained, what's the new outlook? How did they guide for the rest of 2025 and beyond?
They delivered a huge raise across the board. The new 2025 outlook is much stronger. They lifted the full-year revenue growth guidance from a 20-21% range to a new range of 23 to 24%.
That's a 3-point lift on an already big number. And what did they say about the margins?
Profitability is going up even more. Adjusted operating margin was lifted to a range of 12.5 to 12.7%, and that all flowed through to the bottom line. Adjusted EPS guidance was raised from around 77 to 82 cents to a new, much higher range of 88 to 92 cents.
That type of revision tells you they see growth accelerating, not peaking. Did they give any hints about 2026?
They did, and it was very encouraging. They expect revenue growth to be at the high end of their long-term target, which is that low double-digit to mid-teens range. And on top of that, they're projecting another 30 to 70 plus basis points of operating margin expansion. It just signals total confidence in their strategy.
Which brings us perfectly to our final segment, where we take all this data and distill it into one potentially outrageous but entirely plausible trade idea.
And this is our important reminder. This is not financial advice. We're just looking at the fundamentals from the call and discussing what's plausible.
The story here is just so compelling. You've got two premium brands firing on all cylinders. You're reducing risk, expanding margins. So what's the plausible but outrageous trade?
Well, what's critical here is that even after that big 8 or 9% rally, The stock is still trading around $33. That's still about 20% below its high from back in August. So the market is still pricing in that short-term friction.
So the thesis is that the market is too focused on the temporary noise, the U.S. cleanup, and it's missing the bigger compounding story that's coming.
That's exactly it. The company is turning into a high beta compounder, a growth stock that really moves when the fundamentals click. And since we know that Salomon cleanup should be stable by the first half of 2026, the real re-rating, the full market appreciation, should happen in the second half of 2026.
So we want to bet on that stabilization date and sort of bypass the near-term volatility.
The trade idea. A leveraged midterm bullish bet, specifically buying the AS $40 strike calls expiring in late 2026. The timing on that is key. It lets you sidestep all that wholesale pruning noise and bet on the stock re-rating toward the analyst consensus price target, which is around $44. That's significant upside as the clean growth story takes hold in the back half of next year.
A really compelling argument built on this transformation story that seems to be accelerating.
It absolutely is. The shift from a winter-focused equipment company to a year-round premium apparel and footwear platform, it's happening faster than anyone expected. It was just a classic beat and raise powered by real strategic execution.
And the question for you to think about is this. Today's big rally definitely closed some of the valuation gap, but does this report mark the beginning of a structurally higher, more stable growth rate for the entire company? Something to watch over the next 18 months.